Investors, I need your undivided attention. Does the current market sentiment give you a sense of safety that feels artificial? You look at the paper gains in your portfolio, those green numbers flickering on your screen, and you think alpha is just within reach. You feel like a genius. But snap out of it. We need to look at reality with cold, surgical objectivity. What I am about to show you isn't designed to manufacture panic. It is a ruthless deduction based on hard data. Look at the current macro cycle. Do you know what the models are screaming at us? I don't see sustainable prosperity. I don't see the concrete foundation for a bull market. What I see is an imminent, structural, and violent liquidity crunch. We are staring down the barrel of a comprehensive valuation correction. Wall Street's harvesting machine has already been fired up, waiting to trap the unaware, yet retail capital lacking any hedging is still blindly leveraging up. You think this is excessive pessimism? You think this is just a baseless warning about tail risk? Fine. Today, we aren't going to discuss dry macroeconomic theory or complex technical chart patterns that only confuse you. Today, right now, I am going to hand you a direct risk hedging strategy. I am giving you the keys to defensive asset allocation. Stop asking rookie questions like, is there more upside to the market beta? When systemic risk hits, the key metric isn't the amplitude of your potential gains. It is the resilience of your balance sheet. On the eve of this valuation bubble bursting, in this moment of irrational exuberance, I have filtered a list of deep defense assets. Allocating to this list isn't about chasing high returns, it is about capital preservation. It is about ensuring your portfolio is among the few survivors when the market clears. Pay attention, sharpen your focus, write these tickers down. They are your future liquidity lifeline. The counter-cyclical king, Walmart. First, we analyze the true retail giant, the absolute core of counter-cyclical assets, Walmart. Do not underestimate this retailer's economic moat. During economic expansions, when money is cheap, you might ignore its value. You might think it lacks growth elasticity compared to tech stocks. But when the macro environment turns down, when asset prices deflate, when disposable income drops, and when you face real layoff risks, Walmart becomes an absolute necessity. It is the bottom line support of the US consumer economy. Why do I define it as the king of counter-cyclicality? Because of a brutal but effective economic logic. When a recession cycle starts, that massive middle class, the people used to shopping at Whole Foods or Target, will see their spending power instantly downgraded. Their consumer psychology undergoes a structural shift. They stop caring about brand image and start caring about survival. To hedge against inflation, they are forced to migrate into the Walmart ecosystem. This is the trade-down dividend. Walmart is like a giant liquidity black hole, absorbing all the purchasing power squeezed out by the economic downturn. Its supply chain management is hyper-efficient, its cost control is extreme, and it possesses pricing power that crushes competitors. In the hard landing that may follow, Walmart's foot traffic will actually grow, and its cash flow will remain robust. Being long, Walmart is being long, the inevitable trend of American consumption downgrading. It's not just a ticker, it's a hedge against social instability. Next, we discuss a giant with extreme defensive attributes, Procter & Gamble. I define this as the king of resilience. Imagine this scenario. If liquidity dries up tomorrow, if economic activity halts, will you stop buying cleaning supplies? Will you stop personal care? Will you stop buying baby essentials? No, you won't. You might cut back on travel, you might delay buying a car, but you will not compromise on hygiene. That is the foundational logic of P and G. Brands like Tide, Gillette, and Pampers constitute non-cyclical consumer staples. This is demand you cannot strip away. P&G's core advantage lies in its pricing power and brand loyalty. When CPI inflation data spikes, P&G raises prices. Consumers might complain, but they won't switch to generic white label products because the switching costs and quality risks are real. You don't risk ruining your clothes with cheap detergent. That is a moat wide as the Pacific Ocean. More importantly, P&G has increased its dividend for 67 consecutive years. Think about that. That period covers the Cold War, the oil crisis, the dot-com bubble, 9/11, the subprime mortgage crisis, and COVID. Despite geopolitical chaos and macro volatility, P&G kept paying shareholders. In a future where volatility spikes, that guaranteed free cash flow is more valuable than gold. Then there is the familiar liquid asset Coca-Cola. Do not simply categorize this as a beverage company. This is a legal distributor of an addictive consumer good. It is a cash flow machine. Its global distribution network penetrates every capillary of the economy, from Manhattan, skyscrapers, to rural villages in emerging markets. You might lack infrastructure, but you can always find a Coke. That is unrivaled market penetration. In an economic depression, big-ticket spending halts. Durable goods demand hits zero. But Paying a few cents for an ice-cold Coke to get a hit of instant dopamine? That is a price point every class can afford. This is the lipstick effect in action. When people can't afford houses or cars, they treat themselves to small, affordable luxuries. Plus, as a dividend aristocrat, its yield is incredibly stable. When you are watching tech growth valuations collapse, the notification of a Coke dividend hitting your account will be the only stabilizer in your portfolio. Since we mentioned beverages, we must mention its rival, but one I weigh equally in a defensive portfolio, PepsiCo. Many have a serious cognitive bias, thinking Pepsi is just soda. Wrong. Pepsi is a food giant disguised as a beverage company. They own Frito-Lay, Doritos, Quaker Oats, a massive snack business line. This gives it a superior, diversified hedging advantage over Coke. Think about it. When unemployment rises and anxiety spikes, snack consumption rises alongside soft drinks. This low-cost, high-calorie intake is a psychological coping mechanism. It's comfort food. Pepsi's beverage plus snack dual-drive model makes it as durable as an armored vehicle. No matter how the economic cycle rotates, basic caloric intake is rigid. That is Pepsi's secret to crossing cycles. Now, we enter the healthcare sector, absolute rigid demand that crosses all cycles. The top pick is Johnson & Johnson. I mentioned this company with the utmost seriousness. It is one of the few companies left on Earth with a AAA credit rating. Do you know what that means? In the models of rating agencies, J&J's risk of default is lower than the US Treasuries. The federal government might shut down over a debt ceiling, but J&J won't. Its balance sheet is solid as a rock. Even if the financial system suffers a meltdown or a banking liquidity crisis, J&J remains stable. With its two pillars, medical tech and innovative medicine, it dominates everything from operating room equipment to blockbuster oncology drugs. Buying J&J is going long on the infrastructure of the entire medical system. In moments of market panic, when credit spreads widen, J&J is the safe haven where you can park your core capital. I also have to give a strong buy rating to Merck. It is widely recognized as a source of bear market alpha. Why? Because it holds the pharmaceutical nuclear weapon, the anti-cancer drug Keytruda. Here's a brutal macro fact. Disease does not read the news headlines. Disease does not care if the Fed hikes or cuts rates. No matter how ugly the GDP print is, a patient's need for treatment is completely inelastic. Cancer doesn't take a holiday during a recession. Keytruda's dominance across multiple tumor indications provides Merck with predictable, powerful revenue growth. Even if the broader index crashes, as long as Keytruda's patent protection holds, Merck's earnings have the hardest floor imaginable. It is the best offense within a defensive strategy, a high Sharpe ratio asset for your portfolio. Let's look at United Health. This is the absolute hegemon of the American managed care industry and a holder of supreme pricing power. You know the cost structure of US healthcare. Without insurance, you can't move an inch. UNH sits at the top of the value chain. It has massive scale effects, squeezing costs upstream from pharma and hospitals and passing costs downstream to consumers and corporations. Medical inflation? No problem, they just pass it through via premiums. As the largest health insurer in the US, it is like an infrastructure toll booth. No matter how the economy fluctuates, if medical activity exists, you pay the toll. While this business model may seem cold, for investors, it is a perfect cash flow printing press. Its earning stability is enough to make any high volatility tech giant sweat. The anchor's utilities. Finally, for the ballast position of this portfolio, we must allocate to utilities Duke Energy and Southern Company. I know, these companies have low beta, they seem boring. But investors in the institutional world, boring means low volatility. Boring means safety. These are regulated utilities with natural monopoly attributes. If you are in their service area, you must use their grid. It's a zero-sum game. Whether your personal balance sheet is expanding or in recession, basic energy consumption is rigid. This guarantees absolute revenue stability, almost decoupled from the economic cycle. Furthermore, they are bond proxies. While high interest rates have diluted their dividend appeal recently, listen to me. If a recession is confirmed, the Fed will pivot to cut rates. Once the yield curve drops, these utilities with stable high dividends will instantly re-rate and become targets for capital inflows. They are the anchor in your portfolio, ensuring you don't suffer a catastrophic drawdown in the storm. Okay, the watch list is delivered. Now, I know some aggressive investors will object. These traditional companies lack imagination. I want growth. I want 10x returns. Stop. Stop this irrational greed. To make you abandon these fantasies and prove this list is based on quantitative backtesting, let's look at history. Let's see how these companies provided alpha during past liquidity crises. History is the best stress test. It's brutal, but it never lies. Let's rewind to 2022. You remember that year vividly, right? Runaway inflation, aggressive Fed hiking, the Nasdaq crashed 33%, the S&P 500 fell 19.4%. All the growth tech stocks suffered a valuation kill. Tesla was cut in half, Amazon collapsed. But in that moment of rock bottom risk appetite, how did our bear market hedge, Merck, perform? It rallied 45%. Did you hear that? The market crashed double digits and it booked a 45% positive return. Why? Because institutional money flooded into healthcare for safety. Coca-Cola, up 7.4%. Pepsi, up 4%. J&J, up 3%. While your portfolio was bleeding out, investors holding these defensive assets were making money. Why? Because no matter how high inflation gets, consumer staples and healthcare demand remain rigid. Go back to the 2020 COVID crash. That was a true liquidity crisis. The VIX exploded and the S&P 500 dropped 34% in a month. Everyone was dumping assets for cash. But Walmart? It only dipped a negligible 3% to 5%. In a crash where correlations trended toward 1, that is a statistical miracle. Why? Because when the market thought the world was ending, Walmart became the infrastructure keeping society running. Panic buying, toilet paper, food. Walmart was the core of supply security. By limiting the drawdown to a fraction of the market, it preserved the capital you needed to bounce back. Still not convinced? Go back to 2008. The global financial crisis. The worst recession since the Great Depression. The financial system was on the brink of collapse. The S&P 500 plummeted 38.5%. If you were heavy in financials or real estate, your net worth went to zero. But in that year of total despair, Walmart actually rose 18%. Check the data, up 18%. That is the classic counter-cyclical effect. The worse the economy gets, the more foot traffic flows to Walmart. That is why I give it the highest weighting. It is the true source of alpha in a recession. So, investors, are the market signals not clear enough? Look at current valuations. The S&P 500 PE ratio is near 30x. The price to book is in the 99th historical percentile. What does that mean? It means extreme valuation bubbles. It means the risk-reward ratio is totally mismatched. History proves again and again that when valuations deviate this far, only one thing follows: mean reversion. And the process of mean reversion is a crash. It is an asset price reset. At this critical juncture, are you still counting on those tech stocks with a price-to-dream ratio in the hundreds to protect you? Don't dream. When a liquidity crunch happens, the liquidity of those stocks goes to zero. They are toxic assets. The Noah's Ark list I gave you today: Walmart, P&G, Coke, Pepsi, J&J, Merck, United Health, Duke, Southern. This is your only survival hedge. Don't try to be a hero. Don't try to squeeze out every basis point of yield. In this environment of extreme asymmetric risk, your priority is absolutely not chasing high beta, but avoiding permanent capital loss. Protect your core capital. Rotate your positions out of those overvalued bubble assets and into these battle-tested defensive fortresses. It is like packing a parachute before the plane stalls. You might feel like you're underperforming the market right now, suffering from FOMO while others party in the bubble. But listen to professional advice. When the storm actually hits, when everyone else is panicking, when your peer is crying because his 401k shrank by 50%, you will thank this strategy. You will be grateful to the version of yourself that listened to this analysis today. Don't be misled by the noise of mainstream media. Don't be fooled by sell-side analysts. They just want you to provide liquidity for them to exit. The market is a cruel zero-sum game. When the tide goes out, only those holding these defensive core assets will survive. Listen to me. I don't want to see you filing for bankruptcy in a few months. I don't want to see your accumulated wealth evaporate overnight. Execute the strategy immediately. Now, clean up your portfolio. Build your safe haven. Stay liquid, stay safe. Only the paranoid survive. That is the market analysis for today. Remember my logic. I'll see you next time if the market still allows us. Next time. Peace out.